Today, a closer look at Teqnion AB. If you've been following the company, you know it's down a painful 16% after releasing terrible earnings. 3 of the 4 analysts from the Dutch investors own Teqnion, and we'd like to share our thoughts on it. Is this a buying opportunity, short-term noise, or are there deeper cracks in the foundation? Let's find out. Back in June 2024, our analyst Matthijs did an entire fundamental analysis on Teqnion AB, and it's free to listen or read for anyone interested over on the DutchInvestors.com. Teqnion is one of those companies that has all the traits of a perfect company. It's a Swedish serial acquirer focused on niche industrial companies. They have transparent and honest management, strong acquisition track record, and a history of doubling earnings per share every 5 years. They are inspired by Berkshire Hathaway's success, by the one and only, yes you know him, Warren Buffett. So there is a lot to like about the business itself, but the machine appears to be sputtering. Before we dive into the earnings report, the problems and what to do with it, a quick overview for those that don't exactly know what Teqnion is and does, and what makes them unique. Teqnion was founded in 2006 by Joe Steen and 2 other partners. The company focuses on acquiring private companies, which means that Teqnion can be called a serial acquirer. The most common approach is to acquire private companies, integrate them into your portfolio, and reallocate resources to maximize shareholder value. Teqnion invests in industrial niche companies with a high degree of profitability and a strong management team. And the goal is to double EPS every 5 years, using a decentralized model. Considering that Teqnion tries to invest in boring companies, there is a natural advantage. People don't like investing in boring companies, which means that Teqnion experiences less competition. A unique and personal style is maintained within Teqnion, because Teqnion does not let companies go bankrupt. It does not move subsidiaries to another location, and companies are allowed to allocate money themselves. And this is a huge advantage when it works out. But, as we'll find out later, this can also be a risk. There is a lot to like about the company, but let's head on over to the bad news. So, first, the elephant in the room. The annual report scored an F. Literally. That's the grade CEO Joe Steen gave the quarter. And he didn't sugarcoat it. EBITA down 58%. EBITA margin shrank to a weak 3.3%, down from a very healthy 9.6% last year. Earnings per share down 62%, and free cash flow created by 34%. And the stock is getting punished pretty bad, and perhaps rightfully so. Investors don't like seeing acquisition-driven companies hemorrhaging profitability, because it raises a scary question. Are they just buying revenue without improving the bottom line? Joe Steen is brutally honest, and that's refreshing. Here's what he said in the earnings call, and I quote, "With such poor results, we don't even deserve to compete in the game of capitalism." And that's tough. But this is also what makes Teqnion so interesting. Management isn't in denial, they know the problem and they're acting on it. They installed 4 new CEOs in underperforming subsidiaries. They renegotiated supplier contracts to cut costs. They merged 2 manufacturing units, and they made some pretty tough staff cuts. They're taking action, but is it enough or is it too late? Now, since I don't own Teqnion myself, but my 3 colleagues do, I asked their opinion on it. And based on what they said, and checking out the report myself, it comes down to a few things. Teqnion is struggling with legacy companies they have acquired from before Daniel Zhang joined the company in 2021. Especially with one of their largest holdings, Grimstorps. This company makes wooden house frames and roofs, and if the real estate market is slowing down, these types of companies have a very difficult time. They tend to be very cyclical. These companies put enormous downward pressure on Teqnion's profitability, especially in the short term. 2. The newer acquisitions in the United Kingdom appear to be a lot more profitable, which hopefully helps the long term for Teqnion. For example, in fiscal year 2023, they did 3 acquisitions with an average EBITA margin of 25%. These are a lot more profitable, it appears. Management is honest and very aware of the poor report. And they are taking serious actions, as I mentioned earlier. So it's about looking into the future basically, which is very easy of course. No, just kidding. I mean, we can't look into the future, but if you are interested in Teqnion, it's about having faith in Daniel Zhang making the right acquisitions. Johan Steen, the founder and CEO, took a different role and is trying to improve the lacking subsidiaries. So Teqnion is aware of the problems and it is very interesting to see what they're going to do about it. Now, what is concerning, and this is my last point, number 3, is that the stock market and companies have been operating in an extremely favorable economic climate over the past 5 to 10 years, even with interest rates going up a little bit. It's still a lot lower than many years ago. Many serial acquirers have performed extremely well in recent years, yet Teqnion continues to lag behind. Teqnion has declined 36% over the past 12 months. And to give you an idea of how other serial acquirers performed over that same time period, Constellation Software is up 33%, Topicus is up 29%, Lifco up 48%, or Indutrade, another Swedish serial acquirer, is up 19%. So it's not a bad time for many serial acquirers, and I understand it's not an apples to apples comparison, since many of them invest in different kinds of sectors and industries, but it does tell me that they have been able to acquire new companies, grow revenue and profits. So this is something that worries all of us. So what's the difference between Teqnion and many other successful serial acquirers? To answer that, we need to zoom out. What separates a great serial acquirer from a mediocre one? Like I said before, a serial acquirer is a company that grows primarily by buying other companies, rather than just expanding its own operations. Great acquirers buy boring, high-margin businesses at attractive multiples. Teqnion follows this playbook, typically acquiring niche businesses at 4 to 6 times EBITA, which is fair. Another characteristic of this space is that the acquired businesses usually operate independently through a decentralized structure. Berkshire Hathaway and Constellation Software are excellent examples of this. But this appears to be one of the areas where Teqnion is actually struggling. A great acquirer buys businesses that can run independently. Constellation Software subsidiaries are completely autonomous. Teqnion, on the other hand, is stepping in to fix a third of its portfolio. And that's a problem. It suggests that either 1, they're buying lower quality businesses than expected, or 2, they aren't letting them run as independently as they claim. They could sell off these businesses, but that would mean abandoning their philosophy and strategy. Berkshire Hathaway has always emphasized in its annual letters to shareholders dating back to the early 60s that they aim to own the companies they acquire forever, while allowing them to operate independently. Another important trait for excellent serial acquirers is that they compound cash flows into more deals, more cash flow. It's a snowball effect. Buy profitable companies and use their cash flow to buy more companies. But Teqnion's free cash flow is dropping, and that means less fuel for new acquisitions. And it raises the risks of taking on more debt. A snowball rolling downhill gains momentum, but once it slows, getting it to move again takes much more effort. So Teqnion is walking a fine line. They aren't falling apart just yet, but the warning signs are there if you ask me. One thing Teqnion badly underestimated is how cyclical their portfolio actually is. They promised an all-weather portfolio of niche, industrial businesses, but in reality their earnings are more tied to the economy than even management expected. The housing-related subsidiaries hit them the hardest because the weak Swedish housing market has crushed companies like Grimstorps, but also Hem1. But also manufacturing and construction segments due to higher interest rates slowed down the industrial spending. And the irony is that many of Teqnion's worst performing businesses were acquired between 2018 and 2021, before Daniel Zhang came on board. Back then, interest rates were near zero. Money was basically free, and fast forward to 2025 and those same businesses are now struggling. And this is a reality check for both Teqnion and investors. They are not immune to downturns. Despite the terrible numbers and bad news show, there is hope. Management still has a lot of skin in the game. Johan Steen and Daniel Zhang own a ton of shares. And last time we checked, this was roughly 125 and 20 times their annual salary, respectively. They win if shareholders win. 2, they're still buying high-quality companies, and the latest acquisition, Midland Special Fasteners, is a niche market leader with pretty strong margins. So investors are betting that this is just a temporary rough patch, and Teqnion will come out stronger. That's what our analysts believe as well, although they are keeping a closer look at it. I believe the stock will be pretty volatile in the short term because these problems don't disappear all of a sudden. In the long run, if you trust management, this could be a pretty interesting moment to do more research on Teqnion or check out our free full deep dive over on our website. Until next time, stay curious, keep learning, and happy investing.